Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Zed Osmani, Senior Portfolio Manager and Head of Global Equities at Martin Currie, an affiliate to Franklin Templeton, as well as Louis Navalier, Chief Investment Officer of Navalier and Associates, and Sal Narrow, Chief Investment Officer and Senior Managing Director of Coherence Credit Strategies at Tiptree Advisors. They join me to discuss Fed policy, first quarter earnings, China, and where the real investment opportunities are in AI. Gentlemen, we have quite the amount of topics to get through here. Let's kick it off and talk about inflation. Said clearly it's going to be stickier for longer, and judging by the notes I have here, it seems as if the three of you are in agreement.
Yeah, our view hasn't changed since the back end of last year. We think inflation will be stickier and longer lasting. And really, the focus has to be on wage inflation. In our view, wage inflation is by far the largest contributor to midterm inflationary pressures. And when we're looking at the US, at the UK, at the Eurozone, wage inflation remains elevated, even if some regions like the US and the UK, it's starting to roll over. It's rolling over from a very high level. So that's the reason why Christine Lagarde, for example, is concerned about the second round effect of inflationary pressures. So for us, it's all eyes on wage inflation. And for the time being, we conclude that inflation will remain elevated.
Right. And Louis, it appears as if many investors are frustrated with the Fed and how long it's taking to decide if they're going to cut rates or telegraph they're at least going to cut rates.
Yeah, well, they're conflicting with their own dot plot, and we won't get another dot plot to not this meeting, but the meeting 6 weeks from now. So, but I think there are some green shoots out there. If you look at also good prices, they've fallen 5 out of the last 6 months. We are importing deflation from China. We do have a very strong dollar that helps lower the cost of imported goods. But the real thing we need to crack is owner's equivalent rent or shelter costs. And they're a lot lower in the PCE than the CPI. But if we can get any kind of relief on that, then the Fed should be able to get close to their target range. But they should be cutting before the election. They don't want to have any political criticism whatsoever. And I'm sure you know that Trump will drag them into the debate.
And Sal, when you take a look at the CPI data that came in much stronger than people had expected, what are your thoughts if, we will in fact get any rate cuts in 2024?
Yeah, well, I agree with my colleagues. For us, we clearly think that there'll be 1 to 2 rate cuts. I think the first one will be in June, actually. So we're thinking sort of June, and then the next meeting after that. Probably be 25 basis points apiece. I think that the main reason for that is going to be political. So I agree. Basically, first quarter earnings have really kind of been the saving grace, but both the GDP number was supposed to be 2.5. It came in at 1.6, and both inflation numbers were stronger. So it's quite clear that the Fed doesn't have to cut, but they want to cut, and I think they will cut.
Right. It sounds as if the rationale there, Sal, is because they don't want to get political. It's not necessarily something that they're seeing in the economy that's the catalyst for cutting rates at this point.
Well, we still have this inverted yield curve. Twos and 30s are still inverted by 20 odd basis points. Inverted yield curve is typically a sign of recession. So we're not clear of all the recessionary issues and pressures. We're in this hopefully soft landing. But they do need to make a cut at some point here. And again, I think the politics will be really strong. There's a lot to be said on which way the market will move through the election. There's a lot of geopolitical risk coming up in the next 6 months. Volatility right now, sort of spot vol is like 14.5. It seems awful low for what's about to come between Ukraine, Russia, Gaza, Israel, U.S. elections, et cetera. There's a lot of vol to come. We see the market being a bit tenuous between now and after the elections.
Right. And Zed, when we think about earnings here, we're still in the thick of it. Do you think that perhaps consensus was too optimistic? The reactions really haven't been that strong, even for companies that have either beat or their guidance has been decent.
Yeah, we believe earnings estimates are still too high. There's been negative earnings momentum with the Q4 result season, and we're now entering into the Q1 result season. And we believe there's going to be ongoing downward revisions ultimately. So when we're looking at whether it's Europe, US, global, we believe there's downside risk. We think that some of it is going to be related to that persistent inflationary pressures and therefore the potential pressures on margins. So what we want to focus on is companies that have pricing power. Last year has been a year where companies have managed to navigate that higher inflation quite well. But we believe as we get stickier inflation that there's going to be more differentiation between the companies that can protect their margins because of the pricing power they have and those that will start getting margin pressure.
Yeah. And Louis, it's interesting. I mean, we kind of can't get away from the Mag 7 and the exposure that they have to AI. I mean, NVIDIA was on 60 Minutes last night. That's how mainstream this has become. But you've been early on this and you've noted it. That's not necessarily just the chip companies themselves, but it's the opportunities and the derivative plays off of what's happening in AI.
Yeah, I guess the biggest news was, of course, Meta announced they had to invest more in AI hardware. So that helped NVIDIA and Supermicro rally last Thursday when the market was down. Furthermore, Microsoft finally announced that their investment in OpenAI is starting to pay some dividends. They had about 31% growth there. So that got everybody excited. Previously, Microsoft had kind of disappointed on that front. And then obviously, the cloud computing sector, the energy sector, all that has to be beefed up because AI takes a lot of energy. You know, it's very interesting. I'm in Reno right now, and you know, obviously we have Apple and Google servers here, but our electricity costs have almost tripled. And so the good news, we're green. The bad news is we're going to lose our server farms if they keep this up, because all those server farms go to, you know, hydro, nuclear, coal, wherever they get the cheapest electricity. So, but there's going to be a lot of infrastructure plays.
Yeah, and Zed, this kind of falls into your three large themes that are facing seismic changes, energy being one of them.
Yeah, energy transition being one of them, and it's related to the second one, which is artificial intelligence. And the importance in artificial intelligence is to focus on companies that can monetize from AI rather than the ones that will be spending on AI. And we believe that NVIDIA is really well positioned. Microsoft, as the previous speaker mentioned as well, is probably more likely to be able to monetize because of its stake in OpenAI, but also its enterprise software. And we believe that corporates will be spending on AI more rapidly and more forcefully than any other entity in the economy because they will want to stay competitive or become more competitive ultimately. So what's interesting, Jill, is when we look at a basket of over 50 stocks that are related to AI, over the past 12 months, their share price has gone up by 50%, yet their sales estimates have not changed and their earnings estimates have only gone up by 6%. And if you compare that to companies like NVIDIA, yes, that share price has gone up by 215% over the past 12 months, but its sales estimates have gone up by almost 200% and its earnings by over 300%. So really what we're highlighting here is initially there's been a big push up in stocks that are related to AI. And over the next 24 months, we believe that there's going to be differentiation between those that can monetize from AI and therefore see their earnings momentum stay positive or accelerate, and those that will struggle to show that they can monetize AI.
Mm-hmm. And Sal, back to one of your key energy themes, energy is one as well. So it sounds as if the three of you are in agreement there. And perhaps the question is, does it necessarily have to be one type of energy, or can it be a portfolio of different types of technology and energy? I don't feel like there's, electricity is a one size fits all solution. That perhaps it's a portfolio of energy.
Right. Well, we approach this. We approach investing from the fixed income side, as you know, and one of our top performing sectors continues to be Permian energy. There's a lot of M&A going on in that sector, and I think that's going to continue in a very significant way. We also continue to very much favor the cruise lines and the leisure sector, and also all the short duration financials. So there's a lot of alpha to be had in the market right now. The short side for us, based upon these rates being higher for longer, are things like subprimes as credit card balances keep rising, et cetera, auto loans or default rates are rising. So subprime, specialty finance, packaging chemicals, those types of names are the ones that we're sort of underweighted in. But energy continues to be a very strong sector for us, and we think that that's going to lead part of the performance in the portfolio.
Louis, what about China? I mean, how impactful is this to the investment thesis across the board? We know Tesla's fortunes have somewhat shifted now that Musk, was meeting in China, but we saw what happened, with Apple stock and these companies that have exposure to China. What are your thoughts around that?
Well, the more any company has exposure to China, the more they're being hurt by deflation. So Musk is clearly experiencing that with the price wars of EVs. China produced too many batteries, too many electric vehicles, and too many solar panels. And then, of course, they seem to be having a war against American companies. So Apple is now only fourth in China and only second worldwide now in smartphone sales. So there's a little war going on, and it's I think the main thing to realize is China lost 2.08 million people last year, and the only countries in the world that are growing that I know of are the U.S., Brazil, and India. Every other country is shrinking in population because of the demographic bomb went off. Even Canada's shrinking, which is amazing when you consider how much immigration they have. I guess they figured out it was cold up there. So, it's very hard to grow when you have fewer people. And and then you throw the real estate crisis on that. And so I do think the deflation in China is probably going to spread, and we'll see how many other sectors it encompasses. Their first quarter GDP growth was all inventory building, and they just made too much stuff. And then if you go to Europe, they've dumped their electric cars on all the ports in Europe. Of course, they don't have distributors for those cars, so they're just sitting there until they get some distributors.
And Zed, what about what's happening in China and their support of an economic backdrop? How is that impacting the backdrop for European equities?
Well, for us, there's a few aspects to highlight, Jill. Firstly, on China, there are indeed structural headwinds that the country has to tackle, not least an aging population, as the previous speaker mentioned, but also some elements of increased indebtedness, both on the public and the private sector, and then a housing market bubble, which creates an overhang. At the same time, there is the cyclical aspect, and what we're noticing is that the most recent leading indicators have been somewhat encouraging, both on the manufacturing and the services side. It's the first data point after having been weak on the manufacturing side, so we want to see more evidence over the next few months that this economic momentum is starting to improve from the cyclical point of view. It does seem that the policies have been put in place since the start of the year are gaining some traction. And indeed, Europe in particular is more cyclically sensitive, as we know, and notably more sensitive to the China cycle. So there will be, if there is confirmation that the Chinese economic momentum continues to improve, that there will be some opportunities in Europe indirectly to be exposed to that China cycle, whether it's through sectors like luxury goods or some industrial goods companies that are exposed to China. But the final aspect to highlight is the geopolitical dimension of China. And clearly that's related to the tensions around Taiwan between China and the US. That's creating technological fragmentation. And again, there will be winners and losers from that. So it will be important to be bearing that in mind and be differentiated in exposures.
China has led the world in default rates. Chinese real estate obviously has really suffered the last 2 years. The global default rate in 2023, when you include China, by S&P from triple C's was over 30%, whereas in the U.S. it's 12%. So a huge portion of the Chinese economy has been defaulting, and these higher rates for longer are going to make it more difficult for not only them to refinance, but for U.S. companies to refinance. So there's a huge difference between spreads in the triple C land and then double B and investment grade. That's going to put a lot of pressure even on the U.S. market if rates stay up here for longer with the U.S. companies and European companies needing to refinance.
Yeah, well, I mean, a higher U.S. dollars, clearly going to hurt multinational companies. But when you think about it from the small and mid-cap perspective, perhaps they can finally get, some momentum going behind them with a stronger dollar, perhaps.
It does highlight the four aspects that we look for in companies from everything we've talked about so far. We want companies that have earnings resilience because we still think there's going to be more earnings downgrades. We want companies that have pricing power because of the stickier inflation, and companies with pricing power will be able to protect their margins. We want companies with solid balance sheets, and that's to the point that was just made. And then companies that have structural growth exposure in an environment where there's, in our view, a lack of growth generally.
Louis, do you think the expectations of perhaps some volatility around the U.S. election, is that starting to permeate the U.S. markets at all? Or do you think it's still a little bit early for that?
I think it's early. I mean, the U.S. election is just Michigan and Pennsylvania. So pretty obvious what's going to happen. And obviously Biden spent all his time in Eastern Pennsylvania. You know, he's not welcome in Western Pennsylvania because the LNG ban he effectively imposed. That's subject to environmental review after the election. But all those states that frack for gas are mad at him right now. And so if he loses the election, that's going to be why. And you know, we have Tom Steyer up in Lake Tahoe nearby, and Biden always stays at his house. So it's my opinion that Tom Steyer is the real president, but that's another matter. So
Yeah, well, that's perhaps for MSNBC or CNN. Certainly not a political expert or reporter here, but it seems as if, you know, Louis, the market didn't get its 6-7 rate cuts as it expected. And it feels as if it's kind of pricing in the fact that it's going to be higher for longer. And, you know, despite some of the volatility we saw over the past couple of weeks, you know, continuing to hit new highs in some spots here.
yeah, I mean, the good news is we have easy year-over-year comparisons. So not only this quarter is going to be okay, so is next quarter. We still have positive analyst revisions. Our models say you got to be in the top 35% of the universe of stocks, although the top 5% are extraordinary. So those few stocks that are benefiting from the fact that the Magnificent Seven isn't hitting on all cylinders anymore. So whether that's the NVIDIAs, the Super Micros, the Lillys, the Novo Nordisk, those stocks are benefiting immensely. And so, you know, it's still a narrow market, and I wish it was broader. There is a small cap rally, as you mentioned, underway because of the strong dollar. So there's definitely more institutional buying pressure in the small mid cap arena now, which will help us broaden out a bit.
All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter.